Is now a good time or a bad time to be investing in real estate syndications? How are inflationary pressures and decreasing interest rates impacting deals? And what does the housing supply shortage mean for multifamily investors in the long run? Today, we are going to be covering the economic forces impacting real estate syndications. Hello, passive investors. My name is Jim Pfeifer, and welcome to Passive Pockets. On today's episode, we are bringing on Peter Linneman. Peter is a renowned economist and author. He's appeared on several previous episodes, most recently in April of this year, where he correctly predicted that inflation would dip into more normal ranges by this summer. We are thrilled to have him back. Today, we are going to discuss how the market plays a major role in the success of deals and why some deals have struggled over the past few years. We're going to talk about key factors impacting syndications today, updates on inflation and interest rates, and a surprising trend Peter is monitoring for the future. Let's bring him on. Peter, welcome to the show, and thanks for coming back on.
Well, it's a pleasure to be here with you, and I look forward to our discussion.
Excellent. So much has happened recently that is impacting the market, including a Fed rate cut, which we're going to talk a lot about today. But before we do, I'd like to rewind the clock and kind of understand how we got here. So can you tell us why investing in real estate syndications was so successful, before and then during the early period of the pandemic?
If you invest in good assets and you hold on to them, you'll do fine almost all of the time. There'll always be tough times in the business. There'll always be tough times in the economy. I'm a believer in sort of John Bogle, who was the founder behind Vanguard. And his notion was sometimes might be a little better than others to invest, but you don't necessarily know when they are. So always invest in good assets and a diversified way. And real estate, how did it get difficult? It got difficult because real estate's very capital intensive. And if there's not capital, it becomes kind of a choke point, right? If capital's not flowing. When the Fed said that we're in no hurry to raise interest rates, and then 2 months later began the most rapid rise in interest rates in modern history, it wrong-footed the capital markets, for lack of a better statement. And as a result, anybody who was capital intensive found themselves sort of starved for capital. And anybody who believed the Fed that they weren't going to raise interest rates very quickly found, oops, I trusted them, and it turned out that was not a good thing to do. So that's created a lot of turmoil. It created a lot of frozen activity while people figured out the next chapter.
So was it interest rates the main thing, or were there other economic factors that were an issue as well? Or were the economic factors because of the interest rate increase and the rate of it?
I like to remind people, if we go back roughly 4.5 years ago, you realize 23% of the labor force was collecting unemployment insurance. You realize that we had just had something like 25 million people lost their jobs, that we had companies failing all over the place, that not only was Las Vegas not doing well, it was shut by government mandate. Not only were the theme parks in Orlando not doing so great, they were shut by government mandate. We're in football season. You could not go to a football game. You couldn't fly to Europe or Canada unless it was for a sick relative, urgent business, or you were a diplomat. We forget how bizarre the economy was due to the pandemic and the shutdown, not just here, globally. That triggered everything we've lived in the last 4 years. The good news is we came back. And we came back, interestingly, about as fast as I thought, though with a lot of detours along the way. We still are about 2% below GDP trend. We're not an overheated economy. We're an underheated economy. It's been a lot of twists and turns. We got inflation. Why did we get inflation? We got inflation because we shut down the world's economy. We opened it back up. Demand came faster than supply. That created shortages of almost everything. including labor. Those shortages pushed up prices and wages. Those higher prices and wages brought workers back, brought product back. But it took a couple of years. That was the spurt of inflation. To this point, we're close to having labor back. The main group that's not back to work, interestingly, are women 62 years and older for reasons we don't fully understand, right? I mean, it's not like there's some neat theory, but data-wise, that is the missing group of workers. We have pretty much gotten supply back, except in industry after industry. Think of apartments. What happened was we shut down. Nothing finished in 2020. We then finished all the projects that were started and should have been finished in 2020, as well as the projects for 2021. There was a shortage. Demand came back. Rents skyrocketed. Everybody said, yay. They started developing. That is, the high prices brought about supply, created inflation, but brought about supply. It takes a couple of years to bring back the supply because of how long it takes. And now we're living through a period, not just in apartments, but in general, where we've got a supply spurt. And now you've got a supply spurt with normal demand, which has made the market soft. It made it soft from a very high level. Now what have you had happen is rents stopped going up. You saw the new starts slow down. That's happened everywhere in the economy, not just in apartments. It's happened for bubble gum. It happened for, Coca-Cola. It's happened for everything, the same pattern. And that's why inflation came down, not because of anything the Fed did. It's because we got back to supply and demand balance. The Fed viewed this as a normal recession and recovery. It was anything but normal. In a normal recession, Vegas might be off by 4 or 5%. Orlando might be off by 4 or 5%. They were shut. They treated this as a normal recession and a normal recovery, not realizing how that was completely misdiagnosed. That's why the Fed raised interest rates. You think about why the theory says raise interest rates. So you cool off auto, you cool off housing, you cool off manufacturing that are overheated. Manufacturing was still underheated when they raised the rates and they cooled it from there. Manufacturing still not fully recovered. Auto, we couldn't buy them in 2020. In 2021, 22, we couldn't get them because of supply chain issues. And just as we go out to buy our pent-up auto demand, they raise the interest rates, and the 2/3 of the people who buy them on, with a loan can't afford them. That didn't help the economy. That hurt the economy. I said we're below trend. We're below trend because we've underconsumed in the last 4 years about 8 million autos. They cooled the housing market from a production point of view, not from a price point of view. The housing market had a 3.5 million unit shortfall in single family homes that only got worse when they cooled the market. So complete disaster. Inflation is gone because supply issues are gone, and they still have the interest rate up as if inflation's an issue and they can solve it.
It seems like the impact of the pandemic has mostly run through the economy, or there's still lasting effects, specific effects that you see?
There are still some lasting effects, but most of them are gone. They're gone from bubble gum, but they're pretty much gone from the sports arenas. They're still there a bit in travel and tourism. Why? Because a lot of planes were mothballed. A lot of pilots were let go and haven't come back. There were a lot of ground crew let go that haven't come back. So there's still a bit. Travel and tourism is the same level today as it was 5 years ago. Well, that makes no sense. We've got a bigger economy. It should be much larger. That still has pent up, right? Medical, by the way. Medical still has huge pent up because we really had 2 years where you couldn't get your cataracts done, you couldn't get your hips replaced. So think of all the people that would have had their hips replaced and their cataracts done in 2020 and 2021 that couldn't get them done. All the people who would have normally done it in 23 and 24 are getting it done. Plus, the ones from 2020 and 21 working their way through the system. So some areas are taking longer than others to work through the system.
Can you explain the impact of those rate increases, the interest rate increases on real estate, on syndication investments?
The short-term interest rate, if it's high, is normally reflective of, yes, I'm getting a high interest rate, but inflation is eroding my purchasing power, so it doesn't change my interest in being in long-term assets much one way or the other. But what happened was they raised interest rates and inflation disappeared. So you were getting paid to be in short-term safe money, and you weren't getting it eroded by inflation over the last year, year and a half. So you were getting money for nothing and you were liquid. So what it said is, why get on the train now? For example, in the last 4 months, if you just look at prices 4 years ago by their data and versus today, zero, no change in the last 4 months. If you say, okay, if I take all items, everything in the consumer price index, except one item, which is called owner equivalent rent, which is the rent that they say you pay yourself as an owner, which no owner, including me, understands what it means, but it's 24% of what the calculation of consumer price index. And by the way, if you're a homeowner, you should be happy to know that they say in the last year, the rent you pay to yourself has gone up 6%, whatever that means. I have no idea what it means, so I have no idea if my rent paid to myself has gone up or not. It's the only item in the consumer price index that no one purchases. Literally no one. Now, you may not purchase everything in the consumer price index. No one purchases owner equivalent. If you take that one item out over the last year, inflation is 1.1%. And if you do the last 4 months, it's zero. Now, think about the last year. 1.1% has been the real inflation on the things you buy. You're getting 5.5% on cash, and inflation's eroding at 1%. Why would I go into a syndication? I'm getting 4.5% above inflation doing nothing. And anytime I want to change my mind, it's easy to do. I just go out of cash. So those high interest rates were encouraging people to do nothing rather than something long term. So now come to your question. What happens is they cut the rate? Well, now you're getting 50 basis points less for doing nothing. And by the way, they'll cut again next month and you're going to get 25 basis points less again. And by the way, you start saying, uh-oh, the train is leaving the station. And I want to get back on the John Bogle train, which is I want to get into good assets. Do I know that October, November, December is the right month? No. I know, though, that based on my research and common sense, if I'm in good stuff and I hang on, it'll turn out fine. And I stress to people, for example, if you got in January 2009, that was like really dark days. And if you hung on 6, 7, 8 years, you did really well. And that's because it's good assets, markets adjust, things adjust. And so as the interest rates come down, what it means for corporate real estate is money that's sitting on the sideline in cash is going to say the train is leaving. I want to be on the train. Better to sit on the train a month or two early than have the train leave without me.
Yeah, that's well said. And I do want to give you some credit because you were on this podcast in April of this year, 2024. It is now the end of September. This podcast will release the middle of October. And you said that inflation was coming down and that it was a lock because of the big lag in the PCE, which is the personal consumption expenditure, and the CPI, the lag in housing, which you briefly mentioned. And you were right about that. So the question I have is, clearly, I think you thought the Fed needed to cut and maybe should have cut earlier, but was 50 basis points enough?
Now, I don't think inflation is going to stay zero. I told you for the last 4 months it's zero. By the way, it's going to go negative the next couple of months for the lag reasons we talked about before. But let's not get bogged down in the nuance. It's going to normalize just like everything else in the economy normalizes, but some things take long. So let's say it ends up back at 1.5%. which is kind of where it was for the previous 30 years prior to the pandemic. If it's 1.5%, it says the short-term rate should be 75 basis points higher, should be 2.25, maybe 100 basis points higher to 2.5%. They're still at 4.75. They have huge room to cut, like 200 basis points to cut still to go. And then you say, well, what about the long-term rate? Let's say the 10-year Treasury rate. If inflation is going to be 1.5%, the 10-year Treasury should be 150 to 200 over, which says 3 to 3.5%. That's closer. I think it's like 3.8 as we speak, 3.8 as we speak. But it's got room to come down as well. And the reason it's not coming down is because rather than buying a long bond, I'm just sitting in short-term cash. That's part of the train. Long-term assets are disadvantaged in a world where you're getting rewarded as if there is inflation where there isn't. And that will change, and that will bring that yield down further, which also will help real estate, right? To the extent it improves long-term debts. And as money flows, cap rates will come down. All my research, common sense, as money flows, and it will start flowing as they lower rates. And the more they lower that rate, the more that cash comes off the sideline and gets in the game. That's going to bid up asset prices, which will bring down cap rates. I think that cap rates are, again, let me take an apartment because it's mark to market rent, but a good apartment. So an apartment that's going at a 5 cap today should be back around a 4.2 cap. And why is it a 5 cap rather than a 4.2? Because we have a real shortage of transactions. Why do we have a shortage of transactions? We have a lot of money sitting on the sideline. And when that money comes off the sideline, they're going to have to pay to participate, and that will bid up prices, which will lower cap rates. I think that this is a great time to get in, but I would add to that the John Bogle kind of point, it's always a good time to get into good assets.
Right. And I guess that was going to be my next question is, we have this information, you can kind of see where things are probably going. How does an investor then take advantage of that and position themselves so they can take their capital and get it into the right place at the right time?
So have courage. And, that's easy to say, right? But have courage. Courage is rare and capital is rare. If you have courage and capital, when capital and courage are rare, that's like you've created alpha. You've created the opportunity to generate a bit abnormal return. It's a time to buy in a funny way. I'll tell you when it's the time to buy. This is overly simple, Jim. When transaction volumes are lower than normal.
Yeah, and that's now.
I kind of want to be a buyer when transaction volumes are lower than normal. And then I'm a long-term holder. But if I am going to sell, I want to be a seller when transaction volume is higher than normal. And we're still in a period, and we're going to be there for probably another 6 to 8 months of transaction volume below normal. It'll start moving up as the money flows. It doesn't mean the opportunity to do well disappears. It just means the alpha part, the special part, will disappear. You'll still have the normal good return on normal good real estate, as opposed to now where you can get the normal good return on normal good real estate plus a return for capital and courage.
Going forward, I want to kind of go forward and backward at the same time, if that makes any sense. So rates are decreasing. So how is that going to affect deals that investors invested in 3, 4, 5 years ago, some of which, have had some struggles and some difficulties? How are those deals going to be affected by the rates going down?
In 2 ways. One, the short term. If you financed with floating rate debt, the movement up in the short-term rate killed you, no matter how good the property was doing. Property could have been doing great, but the movement in short-term rate was chewing up all your cash And by the way, also led you to defer capital expenditures and improvements. And yes, you were going to upgrade the kitchens, but you didn't have the money because you're paying it in higher interest rates, right? And that's the destructiveness of too high interest rates, is it makes you do things that are not productive. Like, I should put in new kitchens and get higher rents, but since the higher interest rate taking away all my interest, I'm not improving them when I should. Okay. So as the interest rate comes down, that will free up money. That'll reduce some of that choke point phenomena. That's one way it'll help. Second is it will flow into better refinance opportunities. The rates are not going to go back down to zero. I'm not saying they should have. In the same way they shouldn't been at 5.5, they shouldn't have been at zero. You can have, rent shouldn't be zero and it shouldn't be $1,000 a foot, right? Somewhere is the right point in between. It will free up money. And we forget how dependent real estate's health is on money. It's a capital intensive business. It's a money intensive business. If you are a professional football team, it is a player talent intensive business. And if you've got really good talent, you'll do pretty well. Real estate is a capital intensive business. You've got to put out a lot of money just to control the asset, to do things to it. And when capital gets scarce, tough times. So you want to get there before the capital fully gets reflowing.
And then kind of on the same trend of conversation, what will happen with rate caps on adjustable rate loans now that interest rates are decreasing? Because it was my understanding that some of the issue was because they went up so fast, then you had to escrow these huge amounts that the banks required for your next rate cap. So will that reverse?
It's already happened in the drop of 50 basis points. The cost of a cap has come down considerably. And by the way, it's pretty much they've got a couple more rate cuts baked into the cost of a cap. But as they become realities over the coming months, you'll see those costs come down a lot. The interesting thing is, I doubt if for the next few months, lenders free up the excess money that they had people put aside. Why? Because effectively what they've done is view it as a way to reduce the loan balance without saying they've reduced the loan balance. I made you put up money and I'm not going to give it back until it's kind of clear. Now, at some point, that money will come back because as rates come down, it won't be as necessary. But you hit it. It put a huge cash crimp on people.
Okay, I'd like to pivot a little bit and talk again about inflation, which we've mentioned. But, it has come down. You said short term, it's going to go even below zero, right? Negative inflation. But with all the money printing that occurred during COVID and the cut of the interest rates, there's a lot of talk that perhaps inflation could reemerge at some point. So what's your outlook? Do you see that happening?
No. We did print a lot of money during the pandemic, and we spent a lot of money. Of the money that was printed, however, most of it we saved. If we had spent it all, it would have been a real disaster. But we didn't spend it all. At first, think of CARES 1. All the money that was pumped in, that the Fed pumped in through the Treasury. Could you spend anything in April 2020? Was there anything to buy? Could you go on a blowout holiday to Tahiti with the money they gave you? You couldn't get on a plane. So the money got saved by and large. And since it got saved, it didn't bid up prices, didn't create the inflation. It was a very unique situation, how the inflation occurred, not because of money, even though a lot of money was printed, but I think people just don't look at the data and see that's because we saved it. Now, some of that money will come out, as I said, as we lower rates. The government spending that has taken place is by and large probably wasteful. By the way, wasteful spending hurts the economy, whether it's done by the government or by someone buying fentanyl on the street as a private citizen. Unproductive spending hurts the economy no matter who does it. There's a lot of unproductive spending. It is not as bad as it appears. You say, it appears pretty bad, so tell me why. And that's because most of the spending is redistribution. All I'm doing is shuffling it around who's getting it. And it's inefficient because we have government employees filling out the paperwork and making us stand in line and so forth. It's not like the money is disappearing. Most of the money is simply going from one pocket to another pocket. The negative is, does it destroy the incentive to work? Does it destroy the incentive to produce? But most of the spending is redistributive, not 100%. I'm not trying to say 100% of it is. You can't expect government spending to be efficient because its goal is to win votes, not to stimulate the economy. Very different objective, right? I mean, you would spend very differently if your goal was to maximize the size of the economy than if it was maximize the probability you get reelected. That's what the spending largely is. I'm not saying 100% of it. That's largely the differential. It tends to be wasteful. It would be wasteful if you and I were the politicians because we would do the same thing. We would do what's useful for us securing our jobs, same as you currently do what's useful to secure your job. I do what's useful to secure my job. Do you, for your job, wake up thinking, is this good for the U.S. economy? No, you wake up thinking, is it good for me securing my job and enhancing my career? Same for politicians, except they have a bigger budget.
So how will inflation then over the next few years, how will that impact investors? Because it's had a great impact over the last few years, and prior to that, it had a great impact because it was so low. So what's the future look like for investors?
I think we go back to a pretty moderate inflation environment. There are technologies at work that will push down inflation over time, not negative, but will push it down or moderate it over time. AI maybe could do that, but other technologies, you have the rate of monetary expansion will normalize. We're no longer in a bizarre situation, not just here, but around the world. It'll normalize. That will normalize inflation. Yes, we have a lot of government spending, but essentially the money doesn't disappear, right? It's not the spending, it's the misincentives that the spending does that are the problems. The impact is second order. It's unfortunate, but I think you have a pretty modest inflation environment moving forward.
In the U.S., there's a growing wealth gap between the middle class, the upper class, lower class, maybe lack of wage growth recently. And, it's just getting more difficult to purchase a home for many Americans, and maybe they're renting longer. So how do we get more rental supply? How do we create a healthier middle class?
You know what the number one predictor of wealth is in the United States? Age. And I would suspect it's true. I know it was true of me. I had no wealth when I was in my 20s, and I have some wealth today. And it's not just about me. It's true in general, right? That wealth is highly, highly correlated with the age of the wealth holder. How do we get our housing market back to something that people can afford? It's a very difficult task. We have underbuilt single family housing by about 3.5%. So about 3.5 million out of 100 million units. That's a big gap on something people really want. That's why home prices go up. It's good news for the rental market if you're a landlord. Why? Because it means home prices keep rising. And as they rise, I have to save longer to buy a home. And that means I'm renting longer than traditionally. And you can see how that's good for apartment owners. You say, well, how does that 3.5% get eliminated? I think it's very difficult in a world of NIMBYs and in a world of realistic politics. What's realistic politics? This is overly simplified. 2/3 of all people own their home. Do they win or lose when home prices go up? The answer is they win. Okay. Now, some win more than others. The ones who win the most are the ones who are in their ultimate home that they're going to do the rest of their life. The ones who lose are, I own, but I've got another child on the way and I've got to move up, a bit. So they're going to win on the sell, but lose on the buy, right? So you can imagine some homeowners just purely win. Probably 40% just are pure winners. And then you probably have 25% or so of the population own, but they win and lose as home prices go up. You've got about 15% of the population are renters who would like to purchase in the next couple of years. They unambiguously lose. Unambiguously. Why? Because the home price keeps going up, makes it more difficult for them. Interestingly, 20% of the population pretty unaffected. Why? They're lifetime renters. So what's happening to the owner side is of second order concern. So if you think about it as a layer, you've got the 20% of the population are lifetime renters, kind of unaffected. 15% of the population transitional, very adversely affected. Probably about 20% of the population that are move-up owners. They own, but they want to move up. Adversely affected, but not nearly as adversely because they win on the sell side, even though they lose on the buy. And then you've got 40% just win. You tell me how the vote turns out on that one. I've got 40% just win if we keep it hard to get new housing. I'm in that 40%. I don't consider myself a NIMBY, but I'm in the place I want to be in. I've been in it for a long time. I'm not looking to move up. I don't want a whole lot of new supply, right? Why would I want a lot of new supply? So the politics of the 20% lifetime renters are, I don't care. So when you just do the math, the politics are very difficult.
Is there a solution? I mean, it seems like, we've been kind of pushing the can down the road and we haven't been able to catch up and get enough places for people to live. That seems like a pretty big issue. And I know the politics of it is impossible. So where do we end up?
I think we end up with a shortage of single family housing for at least another decade or so. We get a situation where home prices continue to rise faster than inflation, not necessarily every day, but over the next decade, you'll see home prices run because think about it this way. Even if we built 350,000 more single family homes than normal for each of the next 10 years, we'd only get back to balance. What are the chances of that? Just not very likely. I just think it's very difficult to reverse this, unfortunately.
So how does that then look for investors? Is this for, especially multifamily investors? This seems like, there could be good years ahead for quite a while because this problem might not be solvable, and that just creates more renters in the future.
That's how I see it.
So the last question I'd like to ask are, are there a couple of trends that you're looking at in the economy, and how would those trends affect real estate investors?
I know what you expect me to say is AI, right? It's not. The number one trend I'm watching are the weight loss drugs. And you may remember, I, along with Mike Roizen and Albert Ratner, wrote a book on living longer and healthier and so forth and so on. And I'm fascinated by the weight loss drugs. And people say, yes, but once you go on them, you got to stay on it forever. Listen, once I started an exercise and healthy eating program, I had to stay on it forever. That was not like we'll do it for 3 weeks and it's all done. It's like anything else. Why are they so potentially transformative for the economy? This is round numbers, so don't hold me precisely. We spend about 14%, 14% of GDP every year on maladies associated with overweight, obesity, etc., diabetes, breathing issues, etc. Okay, 14% of GDP. If these weight loss drugs would only reduce that by a third, that would be basically 5% of GDP available every year. Not to mention people feel better, right? So I'm not even counting they're going to be more productive because they feel better, they're healthier and so forth. We could free up 5% of GDP every year forever.
Wow.
We have a $28 trillion economy. That's $1.4 trillion a year we get to do other things with. That's why I'm really focused on. And this can happen much faster than the impacts of AI. I'm not trying to say AI couldn't happen, but AI is not going to create 5% of GDP available in the foreseeable future. This has that potential. And I'm being round in what I'm saying. So that's the number one. And some of that money will get spent on other things, but some of that money will get invested, right? If I suddenly gave you 5% more money to do something with, okay, so fine. You spend 93% of it, but 7% of it you're going to invest. And that's going to help real estate, and that's going to push up prices. So this is potentially dramatic. By the way, in terms of real estate, I haven't figured it all out, but it means that healthcare facilities become less attractive because I won't be in bad shape quite as soon as I have historically been because of the health improvements from the weight loss, etc. So that's the number one trend I'm watching and why I think it has some micro impacts on real estate. But the capital effect alone of 1% of GDP, just think of it that way. What if 0.5% or 1% of GDP? You're talking somewhere between 140 to 280 billion more gets invested, of which real estate might get 10% a year. That's a lot of money trying to find a home.
Yeah, well, you know what? As you might know, I was not expecting that as your answer, but that is absolutely fascinating. And that's another reason why I love having you on the show. Thank you so much, Peter, for being on for your third time. We really appreciate it. And we hope we can get you on again in a few months and catch up.
Terrific. Thank you. Have a wonderful day, everyone.
Thank you so much for listening. As always, check us out at passivepockets.com and sign up for a free trial. We'll be back for another episode of Passive Pockets next week.